Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. It is the week of Christmas. It's our last recording of the year. Everyone's a little bit tired. This is going to be a loose episode.
This is going to be good.
And we've got our very first expert back all the way back in 2017, joining us again. I would assume the most featured guest on Equity Mates.
Yeah, by far.
We haven't done the tally, but I think you've got the title. Andrew Brown.
Thank you very much, Ren. Good morning, Bryce.
Morning, Andrew. So you're here, what is now an Equity Mates tradition, to wrap up the bold predictions that you made at the start of 2023. Now,
Start of 2022.
Start of 2022.
We did warn it's going to be a loose episode.
Now, Alec and I did our wrap on Monday, and boy, were we bullish. We had a few, more than a few.
Boy, were you wrong.
Yes, boy, were we wrong.
I was also bullish about the Sydney Swans making the AFL Grand Finals, so we weren't completely
That paid
wrong.
off.
True.
I was also bullish about Australia winning gold at the Winter Olympics. Wasn't completely wrong there.
Correct.
We were just
So
wrong
maybe-
about our finance prediction.
That's right, yes.
So, Andrew, today we've got 14 of your predictions / I think sort of more just general commentary.
Yeah.
And we're going to go through some of them in detail. Others we will review. But 14.
I'm going to say 10 out of 14.
Whoa, hold on. We'll be the ones judging this.
All right, Andrew. So we've clipped all of your comments from start of the year. Let's jump into the first, which really does put a nice bow on where we're at. But let's have a listen.
There's a good chance that inflation ain't going to go much higher. I'm not saying it's peaked, but it may not go much higher. It may not come down quickly, but this may be the sort of the it. But interest rates haven't caught up with inflation yet. And so what's going to happen over the course of the year is that long-term bond yields will rise, in my opinion, and probably have a 3 in front of them at some stage. Short-term interest rates are going to rise because the Federal Reserve is going to push them up anyway. And as the Federal Reserve withdraws from buying government securities, which of course pushes their price up and keeps their yields down, then the demand for government securities that yield next to nothing by anyone else on the planet is pretty small. So the yields are going to rise, and they're going to rise a little bit in Europe. They're going to rise in Australia as well, despite what the Reserve Bank think. And so we're going to have a situation where interest rates are not going to normalise, but they're going to start on a pathway to normalising.
There we go.
Feel pretty good about that?
I think, in essence, that is what has happened.
Yeah.
For those of you who wonder, the inflation rate in December 2021 in the US was 7%. It's currently 7.1. And it's been to, 7.8, I think, depending on how you measure it in terms of core CPI has been nowhere near that, but obviously the total CPI has. So, in fact, I think what I said was pretty much spot on. The inflation basically, had reached its peak, but it wasn't going to come down quickly, and that's exactly what's happened.
I think we got up to 9.1 in July.
Yeah.
But it was 7 and now it's 7.
Now it's 7 again. And I think the reaction to that can't have been a surprise, which is that bond rates have gone up. But in fact, of course, over the past few months, they've actually come down in the US as well. So the 10-year bond yield in the US peaked at 4.25 in October. And at the time of speaking, it's about 3.5.
So you said it would have a 3 in front
We
of it?
said it would have a 3, and it's got a 3. And short-term rates obviously will catch up. Well, the midpoint of the Fed funds rate is 4.38%. The top end of it's 4.5%. So that's categorically caught up, because I think at the time of speaking, I think the Fed funds rate was 1.
Yeah.
So I think that side of things, I think, is important. The way I tried to break inflation down, not necessarily in the broadcast, was demand pull, which is basically lots of people want to spend lots of money.
Yep.
That's happened and probably peaked. Cost push, that's definitely peaked. That was container freight prices and all those kind of good things, the supply chain. That's peaked. And then inflation expectations and they've probably peaked as well.
Touch wood.
All right,
So,
well-
Touch wood, but that's less convincing than the other two.
yeah,
Nice.
yeah, okay. Well, I think Bryce has written in our Google Doc, yes, in all caps and bold. So, Andrew, I think that tells the story.
Not a problem.
Keep rolling.
Yeah, let's keep going. So the next one was around how you thought about investing for 2022.
Yeah.
So excited about 2022 from an investment standpoint, and particularly from the standpoint of people listening to Equity Mates, a slightly younger population than me, is that you cannot just invest on themes.
So that was the comment / prediction. What firstly did you mean by that?
Okay, what I meant was in, say, 2020 and 2021, I mean, number one, all he really had to do was be long equities, full
Yes.
stop. Just be long the index. But number two, it was actually best to have been long mega cap growth stocks in both of those years. In 2020, it was good to have been long sort of rather more speculative growth stocks and things like that, whereas in 2021, that wasn't the case. That had already started to break down. I think it's fair to say on this one, I wasn't right.
Okay.
Because there was one theme there are in fact two themes that in my opinion, dominated. One we're going to come to in a minute, which is mega cap tech. Okay, that you could invest on that theme, just short it all. Okay?
Oh, right. I was going to say, yeah, because they were down.
Okay, we'll come to that in a second. Okay, but the other theme, of course, was commodities on the long side, and it was commodities that maybe many of you would find absolutely repugnant, but things like coal,
Yeah.
things like gas. Things like oil. I know oil's come way off the boil, but oil went up to $120 a barrel on US crude before coming back into the 70s. So the theme was, and you can see it in the Australian market, which we're going to get onto as well, that was the absolutely overriding theme in the Australian market. If you're going to be in the Australian market, hold your nose and buy commodities that you may not like, and well, you'll have had more money in your pocket at the end of the year than the start.
Yeah.
So that was that wasn't right. The themes were different.
So you're giving yourself a no for that?
I'm giving myself a half no. Okay. Now the reason I say only a half no is one of the other things that happened. There was quite a bit of takeover activity around, and that was right across the market and right across the boards. And that wasn't thematic in any shape or form at all. It was just kind of quite widespread.
Yeah, okay. I mean, I feel like it definitely became more of a stock pickers market this year.
Definitely, no
so
question.
I would have, just looking at that, I would have said yes. But hey, we can go give you half a point.
I'm a harsh marker.
It's like my parents when they play the Good Weekend quiz on the weekend. Mum will try and squeeze out a quarter of a point or a third of a point if she gets it directionally right. So we'll give you half a point here.
Directionally right. All right, the next one, Andrew, was around where you would be expecting to see growth come from in the US market.
There is a real chance in a year when you have midterm elections. So the T word gets put back in the vocabulary, unfortunately, RUMP. Okay. That's going to create a lot of uncertainty again, in my opinion. So I think it's really likely that trying to get 10% earnings growth out of the US in this type of environment may not be that easy. Okay. And it's earnings growth that's got to drive the market because, as I've said, there's not interest rates going to drive it, and there's not enthusiasm by investors going to drive it because they've driven out enough already. So it's got to come from earnings growth. So if you're buying expensive growth stocks, you better make sure they're going to grow this year, because if they don't, they're going to be a little bit troublesome. And that might even include some of the big eight.
There we go. Laid it down.
So a couple of things there. Now, you mentioned Trump.
Yep.
Did you buy his NFT?
No. I should have done. Apparently, I think the resale on them was ridiculous.
Yeah, they're
for
up,
a day.
They're up already like a couple hundred%.
It's a bit like buying DWAC for a day.
Yeah.
It had to be in and out quickly. Yeah.
So
Bryce picked up a couple of NFTs.
not true. So the Trump back in the equation is a tick?
Yes.
Because he re-announced his
He was
going
back
for
in
it.
the equation, but obviously, certainly in terms of the midterms, I don't think had any impact.
Oh,
Yeah,
I think he had a profoundly negative
Negative
impact,
yes,
on
correct.
candidate selection, on
That-
Yeah.
I mean, to be fair, that possibly wasn't what I was aiming at. But,
Yeah.
That's certainly. I'm personally thrilled that's the way it's worked out.
I mean, the only challenge to that was he ever out of the equation?
I think there was a period of time where he went very, very quiet, and then he really did
Yeah.
lift as the midterms came closer.
Yeah.
And his candidates obviously got promoted, and unfortunately for him, didn't do well.
Yeah, but the next part of it, 10% earnings growth won't be easy.
Yeah.
Well, I think from FactSet we're at like 5.6% for
That
the
is
calendar
correct.
year.
That's
so
correct.
It wasn't easy.
Oh, the great irony is that at this time, when we made the tape for last year, which was January, the EPS for 2022 on FactSet for the S&P 500 was 221 points. And guess what it is today? It's 221.
All right.
So in
Right,
fact, 2022 earnings expectations went up into about the 230s and then have slithered back. I think everyone's aware that earnings expectations are being wound back at the moment for fairly obvious reasons. So in fact, you had 5% and a bit earnings growth, but no growth in expectations from when we made the tape last year.
Okay.
So 10% earnings growth wasn't easy. We didn't get there. And I think the big thing, and I was at pains to stress this when we made bold predictions 2022, was that the 8 mega cap tech stocks that I define as the 8, Meta, Apple, Microsoft, Google, Netflix, which I know is a smaller company these days, Amazon, Nvidia, and Tesla. Okay, I said, you've got to remember, guys, they've gone up 16% in the final 3 months of 2021, and on an average basis, gone up 45% over 2021. And the average PE for these guys was about 40 odd. And so I said, wow, these guys got to deliver to justify that. And one of the reasons the S&P 500 is down about 17% is that, bluntly, none of these stocks have delivered, really, with the exception of Apple.
Apple down 20%, Nvidia down 40%, Tesla down 60%, Microsoft down 23%, Amazon down 46%, Meta down 65%, Alphabet down 34%. I didn't get Netflix, but on average, those 7 are down.
Netflix was down 40 odd, having been down 70 odd
Yeah,
at one
yeah,
stage.
yeah.
When
We should have
Bill
bought it.
Ackman sold out.
They're all value stocks
But,
now,
but
right?
I think the conclusion there is that enthusiasm certainly didn't drive the market.
No.
Lack thereof.
Some of those companies, some of them didn't deliver earnings, i.e.
Correct.
Amazon, but some of them definitely have a perception problem, perhaps more than a business problem.
That's fair, okay, but a lot of them have got the business problems came to light for many of them during this year. And the business problem is that the competition between some of these guys in certain parts of the market is extremely robust. Think about cloud, okay? With cloud, you've got Amazon, you've got Microsoft, and you've got Alphabet, all going for the same audience, okay? And don't forget, Alphabet's the laggard in that one, whereas they may be, up front in other things. You've got Apple, who has decisively shut the gateway on Facebook/Meta, who are now going to spend billions to get round that gateway. Tesla, obviously, it's broadly delivered on its numbers, but the fact is the shares were just wickedly expensive, and now obviously it's got this other issue that it's pervading it, it being Musk and his attention to Twitter. So you actually look at it, and each of them, with the possible exception of Apple, which is more to do with just Chinese production issues and COVID and everything else, most of them have had a little bit of a business problem as well, haven't necessarily delivered on the earnings, particularly in the third quarter of the year, where that really came home to roost because advertising is slowing. You might be dominant, but it's still slowing. And so, what you've really had is you've had some issues weighing on them. The earnings multiples were too high. You had no expansion of earnings multiple because bond yield's gone up. And so they just couldn't sustain, the kind of cloud-like ratings that
God
they had.
status.
All right, put a question without notice for both of you. Of the 8, who does the best in 2023?
Nvidia.
Really? Andrew?
Meta.
Oh, yeah, I like that. I'm going to say Microsoft.
In terms of stock price.
Yeah.
All right, jumping the gun on
I
2023
like
performance.
Meta. I actually bought some Meta right at the bottom.
So did I.
Oh, did you?
Yeah, I did.
There you
Absolutely.
go.
Yeah. First time I bought them, yeah.
Wow, there you go. All right, so a few yeses in there, a few nos,
I
but
reckon we give it a
generally
yes.
it's a yes.
I think that's. I'll be blunt. Of all the 14 predictions, that is the one. I
bang
think
on.
that is the bang on nail.
Yeah.
Seriously.
All right, so we've got 2 that sort of center around China and Hong Kong. So I'll play both of them, and then we can have a chart.
The most obvious place to look, because everybody else has said, we are not playing here anymore. We don't want to play on your pitch anymore. We're leaving. And we've sold our stock and left.
Can I guess?
Have a guess.
China.
Nice.
Nice.
Absolutely right. The second place to look is Hong Kong, because Hong Kong got really shredded because Hong Kong was supposed to have some degree of autonomy from China. And obviously, as we saw in 2021, that disappeared. My favourite play in Hong Kong, and it has the ticker symbol 1. Oh, actually, 0001. 1. Hong Kong is basically CK Hutchison.
All right, so first place to look, China. Second place, Hong Kong. How'd we fare?
Not good, but not as bad as you might think.
Okay.
So I'm not trying to wriggle out of this. Okay. Quite clearly, if we had have recorded this in October, I'd have been hiding under the desk in a big way. Hong Kong was down 38% at one stage at its low from roughly the year end. And clearly it was to do with the fact that, 2 real issues, which was that, Xi Jinping's rule over China has been solidified. And so, it really is a sort of one-man state at the moment. And secondly, his view on how to eradicate COVID basically killed the economy. You'll never know how much it killed the economy, but it's pretty obvious it did. And it's only once that those restrictions on COVID have been lifted and, people have been spreading it with alacrity to each other, but the economy's back up and running, that the stock markets in both Hong Kong and China have rebounded. And have they rebounded? Don't forget, in the month of October or November, Hong Kong was up 25% in a month.
Wow.
These things got absolutely pounded. I did talk a little bit about the big tech stocks in Hong Kong, and I said one of the ways to buy them was KWeb. KWeb's down about 17% over the year. It's down about 14% from when we broadcast. So that's actually no worse. In fact, it's better than the S&P 500. But boy, did it take you on a ride. And in essence, both Hong Kong and China took you on amazing rides. And if you dollar cost averaged, you've actually not done too bad. Okay,
Yes.
but that's weasel words. Okay, the simple fact is China didn't do any better than America, and it was a hell of a lot more volatile. In terms of Hutch, CK Hutch.
Just a quick reminder on what that is.
Yeah, CK Hutchison is basically, it's the holding company for Li Ka-shing, who's the richest person in Hong Kong. And it's basically it's a real conglomerate. It basically owns one of the world's largest beauty and health retail chains, which is called Watsons, which is obviously in that region. It's got a lot of port assets in Hong Kong and in China, and of course it's got massive telecom interests, mobile interests in Europe. It owns, for example, the 3 network in the UK. So with Hutch, what's happened with Hutch? It's down roughly about 20% since we broadcast. So it's done no better than markets. Its PE is now 5.
Oh, wow.
So in fact, all that's happened is the PE has gone from about 7 to 5. Its earnings are still actually growing, not very much, but they're growing a little bit. And what investors are looking for in Hutch is actually some mergers and sales of some of the mobile phone carriers that they own in Europe, particularly actually in the UK, where there's a proposed merger between Three and Vodafone. Which is, that's going to obviously get sussed out by the monopoly authorities and everything else, because it is going to make the largest player. So what you're looking at is a bit more capital management, a little bit more merging, and a little bit more earnings growth, and a little bit of a pickup in China, and Hutch at roughly the current price of 45 Hong Kong dollars a share, P of 5. I still own it. I haven't touched it during the year. I've nibbled around, obviously, in it a bit as it's come down, but I still rather like that. It's not a huge play on Hong Kong. It's a bit of a play on Hong Kong. The markets in China and Hong Kong, quite clearly, I think they're just really going to be driven by government again. And, I certainly think, at these types of levels, I do think they're actually, quite interesting at sort of below 20,000 on the Hang Seng index and around 13 on the China A index. I think they're quite interesting simply because it's clear for the government that they still only exist at the behest of the population, and the population ain't happy. And the population, the trade-off, we all know the trade-off in China. The trade-off is basically political freedom for economic wealth. That's the trade-off, and they haven't had the second bit of it.
I guess the big question with China this year is, you ease COVID zero, what actually happens with COVID? We spoke about on our Dive podcast this morning that the official numbers coming out of China are 2,000 cases over the weekend. Some unofficial estimates put it up to 40 million cases.
Yeah, exactly.
So that's a wide range of outcomes.
Absolutely. Look, I think what's quite clear is, don't forget, just the way we have in Australia and around the world, you sort of get used to COVID. We get it now, each of us is going to get it now and again. You might get it once a year. It's not the flu, but we're going to start treating it like the flu, I think is the best way to put it.
So let's put a pin in China. Because let's move to another authoritarian regime that captured headlines this year. And this is probably the bold prediction that stuck out in our mind the most, and that was around Russia.
There's one other market which is actually very, very big. It has some astonishing companies, and particularly just as we speak, for reasons which are extremely obvious, called the Ukraine border, there are a stack of things in Russia that are about as cheap as they ever get. One hint on buying Russian stocks. Number one, you can buy them in London. So you can buy all these things through global depository receipts in London. So you don't have to open an account with a stockbroker. You'd prefer not to. But the second thing is you always buy Russian stocks when there's a political problem. Okay, because they can run extremely hard and get not super expensive, but a little expensive, but they fall to pieces whenever there's a risk of some real political upheaval. And the political upheavals usually revolve around the armed forces. Okay, and they usually revolve around the armed forces sort of poking their nose into a former Soviet republic.
So that was the commentary. Now, you did also do a follow-up written piece that's available on our website, I think around March or April, that was actually from the request of the community, because they listened to this and then wanted your thoughts on, how to approach Russia post-invasion. So where are we at?
Okay, the whoosh sound is the sound of Andrew Brown leaving the room extremely quickly. There are a few things in that which... none of that has worked out. Let's make that abundantly clear. So none of that has worked out at all. The only thing that's vaguely worked out, obviously the oil price has been good, and I think one of the stocks I mentioned was Gazprom. But that stock is down, even though every other oil stock in the world is up by multiples. First of all, the London listings have all gone. They've all been delisted from London, so you either had to get out, or I've been able to convert one of my London listed stocks, which is Spurbank, into Russian stock. So I actually hold Russian stock on one of my accounts, and I can't sell it. But it's, if things clearly will liquefy at some stage in the future. It's just we don't know when. Okay, but they will liquefy at some stage in the future. Hopefully, when someone else is liquefied. Why was that prediction wrong? Before I made that prediction, obviously before I bought any shares in Russia myself, quite clearly I wanted to check out, what is the real probability of Putin invading Ukraine in a serious fashion, other than skirmishes along the border, which have been going on for ages. I read a lot of people that are really, really smart, that know Russia extremely well, and the virtually universal opinion from them was he won't do it, because he won't be able to execute it properly. Even, Bill Browder, one of your guests, Bill Browder said that. Okay, and various other people I listen to that are Russian emigres and everything else, virtually to a person said that he wouldn't do it because it would turn into a disaster. And they've been absolutely right in that it's turned into a disaster, but unfortunately he did do it. So I think it just shows how mentally unstable he is now. He's clearly ill. He's clearly physically ill. I think you can see that as well. So clearly what I did not expect to happen happened. And what I certainly did not expect, and I think I made this clear in the piece that I wrote, was that Europe was so stunningly unified to put in place sanctions against Russia in that way, even though it hindered them economically, because of the lack of gas and to a lesser degree the lack of oil and some other things. So that, that's clearly the fact that he went into Ukraine and then the European specifically reaction rather than the US reaction. And then one of the things that we've now seen, and we've seen it a little bit in terms of the US-China relationship as well, is guess what? Financial warfare is now a real thing. Okay, we will take. If you're a naughty country, we'll take away your access to capital markets. Particularly if you're a bit more of a fringe country, you will not have access to capital markets, and that clearly has caught up with Russia. They've tried to negate that with obvious things like curtailing oil supplies and gas supplies and everything else. How does this play out? Well, look, none of those shares are going to be liquid. I can't sell my Sberbank, but nothing will be liquid until basically the Ukraine situation is settled. And settled does not mean Russia controlling Ukraine. It means Russia getting out of Ukraine in some agreed fashion, whatever that fashion is. And it probably really needs Putin to not be around, to be frank. And my suspicion is that on natural causes rather than bullets and bombs is the best chance of him disappearing.
Did you guys see the story earlier this month that he fell down the stairs and soiled himself? Potentially a bit of information warfare from our American friends, but I like to believe that it's true.
All right, Andrew. So
that's a categoric cross. We can't.
Yes, that's a no.
That one.
All right, we'll move on to a stock-specific comment.
Yeah.
One of the most interesting ideas I've got, and I do have a holding in it, is Dropbox.
Oh, interesting. Okay.
Dropbox is $9 billion business, market cap. It's got net cash. It's got Elliott Associates on the register, which is generally a good thing. Hello, BHP.
Well, Twitter had them, but nothing seemed to
nothing seemed to happen. Dropbox is interesting because they've definitely changed tack.
So that's where we landed.
So let's start with the outcome and then get to how it happened. Dropbox down 7% year to date.
Yep.
But that's the best of a bad bunch when it comes to tech stocks.
Yeah.
We said
Apple
was down 20%, Microsoft was down 23%, Alphabet down 34%.
Yep.
So Dropbox beat them all.
Absolutely.
Were you right in your thesis?
Yes, because what the company's done is just carried on doing what it's been doing for the last year and a bit, which is under pressure from Elliott and others. The company's been basically growing its free cash flow as quickly as it can. Okay, now its definition of free cash flow includes stock-based compensation. okay, which obviously adds to free cash flow. But it's talking $1 billion of free cash flow next year, and about 360 million of that will be stock-based comp. Okay, but it still means they're going to be minting 600 to 700 million of real free cash flow. The market cap's about 8.5 billion. There is no debt. So the thesis that I had close on a year ago, it's just continued playing out. It's just the market hasn't wanted to pay any more for it. Okay, but certainly in terms of delivery, the margins that the company's got have grown quite sharply. They're now up over 80% from the mid-70s. They're continuing to grow customers, and they are continuing to produce genuine free cash flow, which they are using to buy back stock aggressively. They've bought back 7% of the stock this year.
Can you explain the share component of that free cash flow?
Yeah. When we look at if you look at the top, there are three components to cash flow in any set of accounts. There's what's called operating cash flow. There's then investing cash flow and financing cash flow. I'll deal with financing first. It's basically share issuance. But it does unfortunately include leases and rental these days, thanks to the world of accountants. Investing cash flow is predominantly capital expenditure. Okay, so buying new plant, new servers, new whatevers, and things like that. Operating cash flow is obviously what comes out of the business. And quite clearly, if you pay your staff using shares, then you're not paying them cash. Okay, so you have to expense those shares in your profit and loss accounts before you then adjust them out with adjusted EBITDA and things like that. But that has to go through the accounts. But of course, you're not paying out cash because you're giving them shares. And so it boosts your operating cash flow relative to your reported profit. Okay, and there's some of these things are very significant. The big kahuna of this is your favourite Australian tech giant, Atlassian. Atlassian only make cash flow because of the vast amount of stock they issue to employees. And don't forget, this gets harder. When your share price comes down by 3/4, do employees really want that stock anymore? Can they live without it? Do they really want cash? And if the market for tech employees is tight, then basically people will go to places that pay cash rather than stock. Now, as we well know, the market for tech employees may have been tight a few months ago, but it ain't tight anymore. It's getting loose.
Well, Andrew, that's 7 of the 14. I think we give Dropbox a yes. So to recap, we've got yes to inflation, no to investing themes, yes to Trump is back in the equation and earnings growth won't be as easy. Yes. Big yes. The 2 about China, no. Russia, no. Dropbox, yes. So
Thank you.
What are we at? 3. We're about 50-50 at this point.
Yeah, fair call.
All right, well, we are joined by Andrew Brown. We are reviewing his bold predictions for 2022. We've covered 7 so far. We've got 7 to go. And Andrew, this one was all about crypto.
I do believe one of the things I think is really going to happen over the course of 2022 is I believe the crypto world is going to go through some fairly significant upheaval.
Okay. Hit that as a bold prediction.
You can hit that as a bold prediction. And the upheaval is going to mean that Bitcoin and, to a degree, Ethereum are going to get moved out of fashion.
Okay.
Because Bitcoin does nothing. It does zero. It has
people
no
listening
use.
and disagree. Take it up with Andrew.
Yeah, take it up with me. It does nothing. Ethereum does some things. We know Solana does some more things, and then there's a whole lot of other coins which you can ring me up and tell me about, which do lots and lots of things, and will play a role in the metaverse, and they will play a role in distributed ledger technology. They may play a minor role in fintech. I think what's going to happen is in the crypto world, the regulators are starting to come. In a world where interest rates are going up, so your speculation is no longer free, where too many of the old coins are controlled by whales. These things are oligopolies.
Yeah.
Don't come and tell me you love crypto because you are rebelling against the world and you want a new world. That's a nonsense. You're not. You're making the rich people even richer. Okay. I urge you to read a piece by Scott Galloway, which is published recently, which is called Web3.
Yeah.
Okay. And it's about how many of you think Web3 is wonderful, but it's the same old oligopolists. It's just a new bunch of oligopolists trying to get rid of the old bunch of oligopolists. Well, if you want to do that, you might as well reinvest in Russian equities.
So, upheaval, we certainly saw that.
Absolutely. The most interesting thing, I mentioned Solana on there. Obviously, Solana got absolutely smashed to pieces during the year because Solana was one of the coins that was involved in the Terra Luna collapse. It was on the fringes of the FTX collapse as well. One of the things I didn't mention clearly there, and I think the thing that's really come home to roost in crypto this year is it's not just the collapse in the value of these coins and the collapse of exchanges and networks and the fraud that's gone on. What I think stunned everybody is the interconnectedness of these networks, which I don't think until partway through the year really got brought home. And when Terra Luna collapsed, I think it was then that people started to realise, hey, all these guys are linked up, in various different ways, and we didn't really know that. And that, of course, starts to spread fear and panic, or FUD, as all you crypto geeks say. But it's real FUD, because it turned out, they were all lending to each other. They were all utilising, the exchanges to borrow money from. If you don't believe me, just read the SEC indictments against SBF. No, we're not saying that's true. It's an indictment, so it may or may not be true. It's got to be proven in court. But wow, it's pretty amazing stuff. It's like you give, it is seriously not giving you money to the stockbroker, but giving your money to the ASX. And the ASX just take your money and lend it to some hedge fund that they're operating on the side. It's just incredible. It's absolutely incredible. And, I unfortunately know some people in Australia who had money on FTX, thought it was reasonably safe. Forget it. It's gone. Yeah. So, look, I think, I'm not saying crypto's dead, but I think it's pretty badly wounded. And I think for people that are that are pro crypto, to build your case to explain why people should invest in crypto, I think in the future is going to be extraordinarily difficult. And of course, we've got to the irony that you've got people in crypto, the free world, who want the regulators to come and clean things up for them. Well, that's so nonsensical. It's not funny.
There's a little bit of that, isn't there?
There is, which is really poor. So I'm going to claim 11 out of 10 on that one.
Decentralized profits, centralized losses.
Yeah, absolutely. Exactly. Yeah, it's called capitalism, man. Yeah.
All right, the next one was to do with the election.
We've got an election. That election is going to be close. I think there will be a change of government, but they're not going to have a majority in the upper house.
Easy, yes, and yes. Yeah, tick, tick.
All right. The next one, Andrew, got to squeeze in a property one, and boy, did you squeeze one in.
So Australia could be interesting, and if the economy is a lot slower and property prices start to come off, and they will.
That is a bold prediction.
No. Property debt is 96% of GDP.
Are you saying property prices will be lower than...
Yes.
Write that down. That's a bold prediction.
Yeah, nobody expects it.
There we go.
There we go.
Property prices lower.
Well, Andrew, I think we can definitively say you're right there.
Yeah.
Sydney, I think, is down 11%, but
Correct.
Nationally, I think we're down about 3% for the year.
Oh yeah, I think that's taking Adelaide and giving it a weighting of about 40% or something.
Look,
yeah.
it's
more than that.
I'm just deferring to core logic here, but I think either way, property prices are down.
I think what I do want to stress about this, I mean, I think that's I think that's a tick. But what I do want to stress is and it goes back to where we were, for example, on the big 8 US tech stocks. I don't think anybody realised, or not anybody, but a lot of people didn't realise the level of euphoria that there was at the end of 2021. I knew there was euphoria, but I didn't probably realise the magnitude of it. Okay, so you had high PEs. It was a 21 PE on the S&P 500 and expectations of growth, and obviously you had extremely low interest rates here, which I said were going to go up. and property prices that you couldn't climb over at the time. And because property is a geared asset for the vast majority of people, it's meant that people that bought around the end of 2011 and the early stage of 2021 and the early stage of 2022 are obviously in a bit of a hole now. And with inflation the way it is, and if their disposable income if their income hasn't gone up, then their disposable income's gone down, and gone down sharply. So it's it's going to mean a bit more pain, I'm afraid.
Yeah, 2023 will be interesting. All right, so we'll keep moving. The next one was about rates and the RBA.
If interest rates go, you've got to say, I mean, the one institution, you can criticise a lot of institutions in Australia, but the one that in all seriousness, you really should criticise is the Reserve Bank of Australia. They have lost the plot.
And they did get criticised.
By Bryce. Bryce decided halfway through the year he was sick of Philip Lowe.
Philip Lowe,
yeah.
The most damning stuff on the RBA, and I'm even more vitriolic towards them now than I was a year ago. There was a series of freedom of information email releases to do with many things, but the RBA were wondering why one of their economic or econometric models, which is being used by Chris Joy, who runs Coolabah Capital and also is a correspondent for the Fin Review and writes some really interesting stuff for the Fin. And he had a guy called Peter Tulip who used to work for the Reserve Bank, and Peter had developed some of those models, and they were running the models and they were showing basically that property prices were going to go down and go down sharply, and the Reserve Bank's application of those models was showing that property prices were going to go nowhere. Right. And they were wondering why there were, they realised that it was the same model, and they didn't know why there were differences. And there's been some freedom of information releases, and what it showed categorically is the Reserve Bank is just replete with groupthink. Okay, they don't get out there, they don't look outwards, they just look internally. So all they were doing with their models was sort of playing around with the models, trying to make them work a bit better. In other words, they were sort of trying to fiddle the model. And it was a nonsense, and it took them ages and ages and ages to actually look outside and realise what was different, and the fact that Peter Tulip had made a few changes because models change, particularly econometric models to reflect what changed in the economy. And the Reserve Bank have just been shown to be inward-looking, group-thinking people, the top 6 of whom get paid over $1 million a year. That's outrageous. So there's no wonder there's a review into the Reserve Bank, and I'll give you one bold prediction for 2023 right now, which is when I come back at the end of the year, Philip Lowe will not be the Governor of the Reserve Bank of Australia.
Okay.
Full stop. And nor should he be. It's been a disgraceful performance.
There you go.
Be the chair of CBA's board or something.
He'll have another extremely well-paid job somewhere. Look, he's a nice guy, but his performance as RBA Governor has been appalling. It's been dreadful. And the culture of the RBA is as much the issue as his prognostications about interest rates. And he had plenty of chance to walk them back and didn't. But the culture of the RBA laid bare in those emails is awful.
Well, we should say, because it seems that the RBA is a hot button issue in the Equity Mates community. Every time we post a meme or something about it, half the people jump on this bandwagon and start criticising. The other half criticise people that borrowed based on Philip Lowe's forecasts. I think we can say that regardless of how much stock you should put in what the RBA says when you make personal finance decisions, the RBA screwed up.
They did. He could. There was plenty of chances to re-emphasise the conditionality of the forecast. And that wasn't done. And then he sort of says, I did say it was conditional. He had plenty of chances. It was only when his job was on the line that he went on television. And remember, the RBA governor, they don't do press conferences after each rate. After each rate rise. At all. So it's a very sort of inward-looking kind of thing. So I hope whoever the next Reserve Bank governor is, basically they have a press conference at the end of each RBA rate announcement to put some more bones on the bit of paper they put out that everybody uses Word to, see what's changed from last month to this month.
Does Jerome Powell do a press conference?
Yeah, absolutely.
Yeah, okay.
Totally. So it's open, and I mean, sure, the press conference gets misinterpreted sometimes. People place too much store on word changes and things like that. But then that's up to you as the governor to play to that.
We should pitch the RBA to do a podcast.
Not bad.
No pesky journalists asking the questions. You can control the narrative.
You bluntly should ask Philip Lowe to come on here, because it is your age group and your cohort that are probably in the most poo. If they did go deep in 2021 or 2022 in borrowing money for a house, you should get him on.
I think we have asked. It was a no.
Ask again.
We'll ask again.
Keep asking.
We'll use that sound clip.
When
Anyway.
he's scrambling for it, you know what it's like. Politicians go on Kiss FM and subject themselves to Kyle and Jackie O when there's an election.
Is Andrew comparing us to Kyle and Jackie O?
Hopefully not. All right, let's keep moving. We've got one.
Kyle and Jackie O of finance.
We've got one on inflation in Australia.
Labour costs are going up, other costs are going up as well, and it's labour costs that are sticky. And remember, the big thing about inflation, where I might be wrong, what you don't want to see in inflation, and it's starting to happen, is inflation expectations rise. People are starting to say, I want a pay rise. Why? Because my bus fare's more. But if it's still costing a lot more 2/3 of the way through 2022, then we're going to have a problem. Okay? And Australia's not immune from that. You read the Financial Review, it sits there thinking we're immune from all this stuff. Get out of here. We're not. Absolutely not.
Jeez, Andrew, you escalated your how direct you were at some Australian institutions. The Reserve Bank, the AFR.
At that stage, I think, a lot of them were living in dreamland, a year ago. And, go back. You can search the stuff out on the net. It was far too euphoric, far too bullish. So labour costs going up. Look, they have, but obviously they're still not going up, at a rate that keeps pace with inflation at all, which is a bit of an issue, and that's why you're starting to see more and more industrial disruption. A lot of it is government-owned instrumentalities with disruption, transport networks and things like that. But you are starting to see more of that. Inflation expectations. I think that, they've definitely risen, but I do think that people are now so worried about their economic circumstances that's sort of being pushed away a little bit. They're much more worried about their economic circumstances, which is why you see in surveys people working 2 jobs, because they can work 2 jobs. The demand for their labour is there, with 3.6% unemployment. So the demand for their labour is there. Whether they can keep working 2 jobs for their mental health and their physical health is a different matter altogether. But I think the inflation expectations bit, I think it's probably levelling out, and I think you might start to see that inflation's levelling out a little bit as well. Don't forget, we calculate it very differently to what they do in the US. The shelter component in the US is 1/3 of inflation. Here it's not. So here we were much more impacted, I think, directly in the figures by the supply chain, and that clearly has died away a little bit. So it's going to, to me, as I think you've seen with the latest figures, I think inflation's starting to level out here, and if that happens, inflation expectations are levelling out.
All right, 2 to go. This one is on the Aussie market.
I don't think the Aussie market will be that bad, but I just don't see it being that good.
Nailed it.
Yeah.
So America year to date down 19%. Australia year to date, down 6%?
Yeah.
Is that it? Yeah.
That's about right. Yeah, absolutely.
So not bad?
Yeah.
Not good?
Can't go wrong with that.
Well, I think that, the simple thing, as I alluded to earlier on, is basically it was the resource sector that quote saved the market, and in fact, it was 3 letters to some degree saved the market, which was BHP.
I was going to say coal is 4 letters.
Yeah, coal is 4. Don't forget those. The sort of Whitehavens of the world and everything else are much lower components of the index.
Yeah.
But BHP basically did. if you bought BHP at the year end, you paid $41.50. But you've had $4.60 of dividends, and you've had $6.44 roughly equivalent of Woodside shares, with the distribution sort of roughly 1 for 5 in Woodside. So BHP's returned about 37% net. And if you'd have said to me, January 1, 2022, BHP's going to do 37% now, I said, nah.
What do you mean?
No. CommBank's done pretty well, but it's done much better than most of the other banks. So Macquarie's down 15, everybody's favourite thing, which is hardly surprising. The two bellwethers of the economy, Woolies down 9.5 at the time of speaking, and Wesfarmers down 20 before dividends. Don't forget that Wesfarmers' dividend is very generous, and CSL up 3. So CSL's flatline, which is pretty good, but it's been resources that have really held up the Australian market in a much better way. But our bank stocks have actually held up fairly well. They've certainly done better than the US bank stocks did for a while. The US bank stocks have rebounded quite strongly from where they were in September, October.
Is that surprising though, given rising interest rates? Like you would expect the banks to do okay.
You'd expect the banks to do okay in a softly. I mean, don't forget it's been a steep interest rate rising environment, but you'd expect them to do reasonably well for two reasons. First is, don't forget, banks have got equity. Equity in theory is free from a banking point of view. So what we call the endowment effect, which is simply the fact that you're earning sort of 6% instead of 5% on the free funds, obviously helps your earnings. And then secondly, you can increase your margins in a rising interest rate environment. That's not necessarily fully come through yet, because there's been a fair amount of competition in the housing market, and because they're all housing banks now.
True.
And so if you look at NIMs, they've been a little bit variable and they haven't really moved up. But they're all cutting costs like it's going out of fashion. So
What's NIMs?
net interest margin.
Right. Yeah.
Okay. So you can measure it in various different ways, but it's effectively the spread between what you pay on deposits and what you earn on your loans, which you would hope is positive.
And a final one, Andrew, which was commentary on someone who should do quite well in an environment like this.
And who continues to refuse to come on our podcast.
Yes.
I think John, in his own way, has effectively peaked the environment the same as me.
Okay.
Which is John is short what he calls crap, and he's long good companies. And
John's always short crap, though.
yeah, he's always short crap.
Well, John is one of our white whales here at Equity Mates. He said no to us a few times, but one day we'll get him on.
You'll get him on, and this is the kind of environment he does really, really well.
There we go. Do you have any insight on how he's done?
Hold on. Before we go to his insight, I don't think we said his surname.
Yeah, John Hempton.
Yeah, John Hempton, Bronte Capital, Australian short seller.
I do know, I haven't seen John's numbers yet, and they only come out usually, they come out monthly. But certainly the inverted commas crap that he was shorting has collapsed. Or the ones we know he was shorting have absolutely collapsed. So most of the meme stocks have collapsed. Particularly AMC. We know that second line tech has been a horror story. It's stunned me, actually, because in doing my homework to come on here, you sometimes forget and you think it was maybe the year before, the year that you're actually reviewing, and it wasn't. I nearly fell off my chair because I was short this at the old prices. But things like ARC, which is the best bellwether for second line rubbish, ARC's down 63%. It's basically down from 90 odd to the mid 30s. And the reason I'd lost track of it was I covered my short at about 39, and it's actually sort of wallowed around in the 30s for quite some time since, which was mid-year. But I'd forgotten that ARC was as high as 96 and 100 a year ago. Peloton is the other classic. It was down 67% in 2022 to date, and that was after it was down 75% the year before. And things like GameStop were only down 30%. Bed Bath and Beyond, which a lot of people were touting a year ago as a nice recovery stock, it's down 80%. AMC's down about 50%. So all the second line tech stuff that people were still a little bit excited about at the start of 2022 has really fallen in a hole. So I'll call that crap as opposed to fraudulent stuff, which we know John shorts.
Yeah.
So we're giving that a yes.
And I know one of John's bigger holdings is certainly up for the year, which is Regeneron, which I also held for most of the year but don't at the moment.
Yeah, I think he also had a big position in Swedish Match.
Correct.
Based on his Twitter, and did that acquisition ever go through?
That is now going through.
Yeah, so we'll make some money on that.
Yeah. So I'd give that a pretty decent tick.
Swedish Match, Bryce is one of their biggest customers here in Australia.
So, Andrew, that is 10 out of 14. You did say it at the top. That's how it's transpired.
Yeah.
So I think that's a pass mark for sure.
Well, compared to what we did on
Compared
Monday.
to what we did.
I think just to remind the listeners, we do this. We usually record this in January, and it goes to air a week or two later, or a week later, and I don't get a chance to change any of this stuff.
No.
It is a straight out, put everything on the table at the start of the year, and you don't get a chance to change it. So, I have to say, I'm about 4 weeks into this thing. I'm there going, oh dear, particularly with Russia. So, I think I've got to say, I thought the environment, the overall environment, I thought was actually fairly easy to call at the start of 2022 because, I said I thought there was a degree of euphoria. I didn't realise how much. And of course, it's going to presage the fact that I think 2023 is going to be much harder prospect.
Yeah, so we are going to get you back, Andrew, as always, at the start of 2023 for your bold predictions, which we're incredibly excited for. That is going to be a little bit later than normal. Mid-Feb will be when we're releasing that after our summer series. But Andrew, well done. Much better than Ren and I.
Yes.
We'll be taking more notes than usual next time you come in. But thank you so much, A, for your time today, but B, also for the continued support for Equity Mates and the time that you give us each and every year. We do very much appreciate it, as do the rest of the Equity Mates community.
That's my pleasure. What you do for people to help learn. That's the main thing. It's learning and then adapting that education to your style and your way of doing things with a few core lessons underneath. And if I help you do that just one tiny bit, then it's well worth my time coming on and doing it.
Thanks, Andrew.
Thanks for your support and have a happy holiday.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.